Hey y'all. Well, we're here and we're going to talk about financial statements. Really an important part of your record keeping. And I don't know for whatever reason and what order and that sort of thing. We're going to start a unit and it's going to be most of the semester where we're going to be using QuickBooks Online and using a record keeping system, financially anyway. But I think you have to have some wherewithal as far as what you're going to get and what to look for in the end before you actually evaluate and you go construct a record-keeping system from scratch, especially. I mean, there's some of you out there that already are using QuickBooks and that sort of thing. You just want to get better at it, and that's all right. But hopefully you'll pick up a few things here. And maybe a few things will make some sense. But one of the things I just was watching a podcast just a few days ago, and he talked about front sight focused. I love that in regards to business. Is that when you're shooting, you're looking at a target that may be fairly large, but in order to hit that target, you've got to be laser focused on that front sight in order to hit it. And you can think of that your goals and things like that in your business are that front sight. You've got to be laser focused if you're going to reach them. These financial statements are no more than just tools. We've got to have great data in our record-keeping system to build some really good, solid financial statements so that we can base some of the decisions that we're going to make on a daily basis, on an annual basis, and even longer term for our business's health. So anyway, let's delve into the balance sheet and see where it takes us. So some of these I'm just going to go through fairly briefly. And the balance sheet is just for one moment in time, okay? These slideshows, by the way, are available. If you don't want to listen to me, that's fine. I might throw a story or two in there, and, I'm a little windy at times, so I understand that. But anyway, the balance sheet is just a snapshot in time. It's almost useless if we don't know where we've been and we don't know where we're going. It's just for one day in particular, where usually when we're looking at it, we'll pick out December 31st of 2017, for instance. It'll be the balance sheet for that particular day. And it's all about the accounting equation. Some of you are simultaneously taking accounting. And you know that assets equal liabilities plus owner's equity. You probably thought, maybe I don't have to think about that again. But it's all about the balance sheet. It's just that equation comes to life when we take a look at our balance sheet. Okay? So hopefully it'll make a little more sense to you if it doesn't already. If this is all old hat to you, then move on. And that's what we're going to do. Okay, the balance sheet, assets equal liabilities plus owner's equity. The liabilities, the asset side, those are all the resources that are used within your business to generate income. They are your business. And then the right side of the equation, the liabilities and owner's equity. Liabilities equals the debt, but also another unique quality of liabilities is the fact that they show the amount of ownership that's outside the business. Okay, and that inherently owner's equity is held in the business. Okay, and those are the people that are involved in that particular business. In a small sole proprietorship, it may just be you, or you and your wife have all the owner's equity. If we're talking about partners, we've got partner equity, we've got shareholders equity. That sort of thing is what we're talking about. Those people that hold the ownership. And what's the ownership of the resources, the assets that are in the business, and and where they fall as far as debt, liabilities, and held within the business. That's all there is, very simple. The balance sheet shows two things, and what we're interested in looking at. One is liquidity, and that just simply refers to how easily those assets can be converted into cash, and which ones are they of those assets that can be quickly converted. So that's what we talk about when we talk about liquidity. Solvency, on the other hand, which the balance sheet also shows, is the ability of the company to meet its long-term financial obligations. Now, once we've got the picture and the snapshot of the balance sheet in front of us, we can pick these two things, liquidity and solvency, out of there and determine how healthy that business is with that snapshot or unhealthy. Okay? And again, I want to always emphasize, especially when we're just looking at a snapshot, is that for the most part, we want to see where we've been compared to where we are now. And we call that trend analysis. So, and where you want to be. Okay, and are we making it closer to where we want to be as far as maybe it's an increase in net worth owner equity and decrease in debt. So we're going to own more of the assets. That may be a goal of your company and business. So anyway, those are the two things that were mostly involved with the balance sheet. Just the parts of that balance sheet, same thing. The equation, the accounting equation, all things owned by the business. We just went through that. I'm going to move on. Okay. First thing I do when I'm in class is, in order to make sure that everybody has a great concept of what a balance sheet is we do your balance sheet. I'm not going to have you turn this in. I just want you to at least visually go through the process of producing your own balance sheet for your own personal finance reasons. Many of you, if you've got a little age on you, not many are as long in the tooth as I am, but some of you have a lot of business experience, have done this. Anytime you've had to go in there, you had to borrow some money, blah, 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 you're going to do your own balance sheet and show them that you can have the ability to be one of the things that we would show to see if you can repay. But anyway, here's the balance sheet. I'm going to have to move this a little bit. There we go. Okay, here's the balance sheet. Your own personal one. And if you want to use this one, copy it, and I encourage you to use it so that you get an idea where you stand. And then you can take a look at it over time. But you didn't realize maybe you didn't have that much ownership in what you control as far as assets. So anyway, you can change the titles. You can do anything you want with it. We're going to describe each part of this, but change them up. And then we're going to actually talk about the different types of ratio analysis within the balance sheet. There's more. I'm always a big advocate for keeping your analysis as simple as you need. Okay, get more complex, get a little more creative if need be. If you're just keeping records and printing off balance sheets just to print them off, then you've got better things to do with your time as a manager in business. So have fun with this one. And I'm just going to leave it at there for you, but we've got the current ratio describes how you come up with that. Current ratio, working capital, as we'll describe later in the slideshow, are liquidity measures, debt to asset, equity to asset, and debt to equity ratios are solvency ratios, and we want to see some improvement on those kinds of things. It just puts one number, and we can kind of analyze that and just hang on a little bit, see if we've made any improvement over time. Especially, it's what I like to see. and movement towards my goals, my financial goals in this case. Okay? All right, let's get back to the slideshow. Oops. All right, we pause for commercial identification. Now we're back at current assets, parts of the balance sheet. And you guys fast forward through this if it isn't of interest, if you already know. Current assets in the balance sheet item that represents the value of all assets that can be reasonably expected to be converted into cash within 1 year. Okay? And those are the things that we're in the business to sell, those kind of assets. If we're in the cow-calf business, then calves would definitely be an asset that we would actually have that would be on the current asset portion of the balance sheet. If we have crops, if we have stored grains, those kinds of things would be current assets. We're going to sell them in the next year or could conceivably sell those things within that 12-month span of time. Now, the other ones that are current are cash, that or are so close to cash that it wouldn't take much. We could just kind of give them a little nudge and we can convert them into cash quickly. So we got our checking account, we got our savings account, we've got stocks and bonds maybe the business owns. Now, or in the case of your personal balance sheet, it may be a little bit different there. Okay, so those things that are easily converted to cash. Now, let's talk about something called a fixed asset. That's the other bottom left part of your balance sheet. Those are the things, what makes it fixed? Well, those are things that is a little more difficult, or we don't intend to convert to cash. Could be also another definition than even the one that I state here. But you can read. Those are the things. What are some examples of these things? Well, these are the assets that we use to produce the income that we're in business to produce. Okay? So for a cow-calf operation, the cows. If we sell our cows, we can't generate income. So that would be a fixed asset. The land that it takes, that we graze on and that we produce our crops on would be considered a fixed asset. Some other ones would be the equipment that we use. If we sell the baler, we can't bale anymore. Okay? Or the tractor. We can't feed our livestock if that's our major reason, major way that we feed our livestock to generate income. Okay? So, and land and improvements and fencing and all those kinds of things would fit in this category too. Long-term bonds would also, that some people that, I can't just go out and convert them into cash if it's hard to convert them to cash. Or if I'm going to have a hit as far as my income goes, then we put them in the fixed asset category. Okay? Let's go on the right side of the balance sheet. Okay? I don't know why it's on the right, just is. Kind of follows the accounting equation. Current liabilities, upper right corner, those are the things, debts or obligations that are due within the next 12 months, next year. That's all. Some examples of those things would be short-term notes that are due in the next 12 months. If we have a sales account down at the co-op and it's due in the next 30 days, that would be an example of a short-term or current liability. So do you get what I mean by that? Another great example of that would be the current portion of a long-term note. Okay? Most mortgages, most equipment, or even livestock loans, there's going to be part of the principal that's due in the next 12 months. So that's a current liability. Then also the current, we generally on all those kinds of notes, we generate or we accrue interest that is owed, and we might pay it, but once or several times a year. That accrued interest would be also a current liability. I'm sure that there's some others that you can think of, but hopefully you're kind of getting the idea of what goes under the current liability category. All right, now we're on to long-term liabilities. Sometimes we call these fixed liabilities too, so if you don't let terminology get you hung up on any of this kind of stuff, but it's just what it's called. A long-term liability is anything that we owe that is out there more than 12 months. And that would be basically anything, any debt that you owe on livestock or equipment that's beyond 12 months, any debt that you owe on your mortgages or any fixed assets that is beyond 12 months. That's all there is to it. Okay, now we get into a special part of the balance sheet. And that's generally on the very lower. It's at the very end if it's in one column. If we've got two columns, then it's in the very far right-hand lower corner. And that's your owner's equity. Owner's equity is equal to your assets minus your liabilities. Okay, and as we explained before, it's your ownership, or the people involved in the business's ownership in the business. Okay, so there are some special accounts. We're going to talk about those a lot closer when we get into this semester a little more, but I'm going to spend a little bit of time on it right now. Retained earnings are just what they say. They're a part of the owner's equity. They are an owner equity account. Okay, they are accumulative net earnings or profits, retained earnings, profits that are retained. They're kept in the business after accounting for dividends and distributions and what we call draws. Okay, so and we'll describe those here in just a second. So those are the monies that are set aside or left in the business. They're not withdrawn out of the business. And some people refer to them, as it says on the slide, as the earnings surplus. Okay. Other owner equity accounts, and there are, I mean, you can get as sophisticated as you want. I want to stay as simplistic so that I can deal with other management issues. I've got employee issues, I've got payroll issues, and I want to keep my books as simple as possible. So anyway, here's a few others you might run into. Owner's draws. Okay, and that would be those accounts which show up when we take money out of the business. When we take those retained earnings out of the business, we would actually have an owner draw account. Now, for a corporation, they're described as shareholders. For shareholders, they're called a dividend. That's how they come out of the business. We pay dividends. Most of our businesses, this kills me, and this is just kind of an aside, but you have to get used to me going into this kind of stuff. But you know, in the media, sometimes we hear, well, you know, the evil corporate farming interest. Over 90% of farms are corporately owned. Farms and ranches, they always mean that, but they don't always say ranches. And here in Wyoming, we make a differentiation, don't we? If you're from other parts. All right. But anyway, albeit there. The reason that most of us are corporately owned or organized is the fact that we get some benefits from it tax-wise. It's to our advantage to do so. We take advantage of those kinds of things. Who wouldn't? So anyway, maybe you can tell your town cousin or something like that that's actually talking out of both sides of his or her mouth that the reason why we're corporations. We're just small corporations. There's lots of small business corporations out there, and we have to take dividends if we are set up that way. Okay? So another account that we will talk about is capital contributions by the owner. A lot of times especially early on and anytime through the life of a business, we've got the people that are involved in the business that are making contributions into the business. These might be stocks also. Stockholders, if there's a stock generation and sales, and it just means money's brought into the business from an outside source. So it would be that kind of contributions, capital contributions, not untypical of businesses at all. Then a really special and heavily used equity accounts are your revenue and expense accounts. They're part of this thing we call owner's equity. Okay, so this is about as long as I want to make a video. It's already been too long. I'm going to stop it right there. And if you have any questions, let me know. Okay, thank you.